Welcome to Drill Down Earnings. We have quarterly results from Lattice Semiconductor. They're not good. We've got the business story behind the stock on the move. I'm Cory Johnson, Chief Market Strategist from Epistrophy Capital Research, and we look at these Lattice Semiconductor numbers. Wall Street's going to look at the beat or the miss, and the revenues were right in line with the expectations. But Wall Street wanted 24 cents in earnings. They got 5, so the stock's getting crushed. Here's what the business actually did when we look at the numbers. We saw a 34% decline in revenues to get to $127 million. And the expenses really punishing for this company. Operating margins absolutely plummeting down to 6%. This is a business that had 30% operating margins about 2 years ago. So really difficult times at Lattice. Brand new CEO, he's making some tough decisions. A 14% workforce reduction, 14% headcount reduction, or a cost cutting as well. So cutting 14% on operating expenses beyond the headcount reduction, which is to say lots of people are going to lose their jobs. Tough times up there in Hillsboro, Oregon. What is Lattice? So this is the largest volume supplier of FPGA chips, field programmable logic. These are chips that are used in everything: communications, computing, industrial, automotive, consumer. And you would think they would be benefiting from all the things happening in AI and data center build out, but they are just not. This company is really suffering. And they overproduced into this such that their inventory was growing and growing and growing, even as the market was shrinking for them. So less business, continued production has led to some real problems, because if they've got a lot of inventory, of course, their customers are sitting on a lot of inventory as well, which they confirmed in the conference call here. And although they have diverse businesses with communications, industrial, and consumer, that diversity doesn't help when all those businesses stink. Yeah, all three of them are declining. You saw the best of them was communications down only 11%, consumer down 14%, the industrial automotive business for these guys down 51% on a year-over-year basis. So 3 tough businesses that they are focused on, unfortunately. Now, on the conference call, they talked about a Gen AI opportunity, I said in English. They talked about a partnership with NVIDIA to get into the data center, and now they're super excited about that. But there's no let up in sight for these problems, as all of their major businesses have been fading now for many quarters. And so the stock market may be hoping for a bottom here, a V-shaped recovery. It's not happening. Stocks sold off 12% in after hours after selling off 10% over the course of the last year. In a market that's up 30%, just the overall S&P market, forget technology. So a really rough performance. And again, inventory days of inventory, how many days would it take them to sell? If you stopped making anything and they kept selling everything on the shelves, the days of inventory at over 200 days is really bad news, and growing at such an ugly pace, with revenues down 34% and inventory days up 47%. That's real rough on the new CEO, Ford Tamer, despite that great name, Ford Tamer. Ford Tamer talking about we're not at a V-shaped recovery. Maybe next quarter is near the bottom of a U-shaped recovery, but it's going to take some time to come out of this. Here's the first words from CEO Ford Tamer.
Yes, we do believe that what we're seeing is consistent with the broader market that's also indicating a U-shaped versus a V-shaped recovery. Overall, we continue to see softness in our largest end market, which is industrial and automotive. And in that market, we're 4 quarters in what's typically an 8-quarter recovery. So you could see that that would point to a flattish Q4 through sort of mid-year 2025 for this inventory to sort of clear itself up. And on purpose, what we've done, we've worked with our channel partner to glide down that inventory position in the channel to where it goes back to normal inventory by sort of Q2, Q3 of 2025. And we're being applauded by this channel partner for being good partners in helping them do that and sort of getting inventory levels in the channel to normal level, which is about 2 to 3 months, okay? So when we look at our long-term fundamentals, the demand recovers in sort of around the second half, and then starts driving back to our regular run rates of 15 to 20% revenue growth in 26.
So looking for revenue growth, double-digit revenue growth, but all the way out into 2026, that's a rough prediction from the new CEO of Lattice Semiconductor. All right, what's it all mean? What's your big drill on earnings takeaway? And the one number that tells us a whole lot? I'll have that for you. So fiscal Q3 earnings from Lattice Semiconductor, they were rough. It's a challenging quarter for the company. The essential summary tells you, look, a 34% decline in revenues, that's not good. But the one number that tells you a whole lot here is this company is sitting on 242 days of inventory and boasting of being a good partner with their customers, which means they're not going to dump all that inventory in the market, so it's going to be a slow turnaround for Lattice Semiconductor. All right, thanks for checking out Drill Down Earnings. I'm Cory Johnson.